Welcome back to Courage and Goey, the deep dive.
Great to be here.
Today, we're really digging into one of the most polarizing stock stories out there right now. It's dominating Wall Street talk.
Absolutely.
IRE Limited, ticker Iren. This is a company that's made a massive, really high-stakes pivot.
Huge pivot.
Yeah, from the, let's say, volatile world of Bitcoin mining straight into the white-hot center of the AI infrastructure boom.
Right. If you're following anything at the intersection of digital assets and high-performance computing, you basically can't avoid this name right now.
Exactly. So we're doing a comprehensive deep dive today. We want to understand the explosive growth, but also the really intense skepticism surrounding this company. Is it an AI industrial powerhouse or something else?
And the timing, well, it couldn't be more critical for this discussion. Yeah. It's November 3rd, 2025.
Right now.
Right now. And this company's valuation has just, skyrocketed. The stock is up over 500% year to date. And almost entirely on the promise of this AI transformation. But like you said, that narrative has created this canyon of conflicting opinions.
A huge divide.
Totally. On one side, you've got major analysts, Cantor Fitzgerald, for example, doubling their price targets to an eye-watering $100 a share.
Wow, $100.
Yeah. But then on the other side, you have legendary short sellers, Jim Chanos, stepping up very recently.
Yeah, I saw that.
And he's basically labeling that valuation as based on, quote, ridiculous assumptions. Pure hopium, he called it.
Hopium, strong words.
Very strong. So our mission today really is to try and gain some true clarity on this pivot. We need to understand the undeniable growth factors, sure, but also the significant financial risks, the execution risks that stand against them.
Okay, let's unpack this then. Before Iren became this big AI story, they were fundamentally experts in something else, right?
Yeah,
power management.
Exactly, that's the key. They started as a pure, vertically integrated data center operator, focused entirely on Bitcoin mining.
Right, so this history, it kind of defines their dual-engine business model now.
It does. And to really grasp the transition, you have to understand what that original core business was built on.
Okay, tell us about that.
Well, that core mining business established their expertise in running these massive power-intensive data centers, which is, the exact foundational skill set that AI training and deployment demands.
Ah, okay. Makes sense.
So their original operation used specialized hardware, right? High-performance computers called ASICs. You've probably heard of them.
Like the Bitmain models.
Exactly. The S19J Pro, the S19 XP, T21, S21 series, those kinds of machines. And they use them to compete globally in solving these complex cryptographic puzzles. It's the SHA-256 algorithm competition.
Right. The global race for Bitcoin rewards.
It's a massive global energy race, yeah, for those Bitcoin rewards.
And the strategy they developed around mining, it actually shows a kind of cautious approach to volatility, doesn't it? Which seems a bit unusual for a traditional Bitcoin miner.
It is. And it's their key strategy for risk mitigation. Unlike a lot of miners who, hold on to the Bitcoin they earn, hoping the price goes up.
BO dealing, yeah.
Right. Iren sells all mined Bitcoin daily.
Every day.
Every single day on exchanges like Kraken. This policy immediately converts that volatile digital asset into stable cash flow. It minimizes their exposure to sudden crypto price swings.
Smart.
And what's more, they established a strong environmental focus right from the start. They operate data centers in places like Canada and Texas, and they utilize 100% clean or renewable energy.
How do they manage that?
Largely sourced through hydropower up in Canada, and then through the strategic purchase of renewable energy certificates, or RECs, down in Texas. And this focus on clean power, it's not just, ethical. It's actually a competitive advantage in this incredibly power-hungry industry.
Okay, so let's recap. They had the infrastructure know-how, they had the power sourcing sorted, often renewable, and they had the expertise to manage these huge energy loads efficiently. That really does sound like the perfect launchpad for this new growth engine, high-performance computing, HPC, and AI cloud services. How rapid was the shift?
Oh, it was rapid and aggressive and highly strategic. The aha moment wasn't some, stroke of isolated genius. It was really opportunistic recognition.
Recognizing what they already had.
Exactly. They realized they already owned the most difficult to acquire assets needed for AI, which are huge amounts of reliable, cheap power. and the expertise to cool and manage that really power-dense hardware.
So they saw the AI demand exploding.
Right, and they realized they could transition pretty smoothly from hosting specialized Bitcoin miners to hosting these general-purpose, super high-demand generative AI clusters. And they didn't just talk about it. By March 2025, they had already committed serious capital.
How much are we talking?
Well, they procured 1,896 units of the absolute highest demand NVIDIA GPUs, the H100s and the newer H200 series, just to kickstart their AI offering.
Almost 2,000 top-tier GPUs. That's a serious bet.
It's a very serious bet.
So fundamentally, this shift is about swapping commodity risk for like utility predictability. Is that right? Because Bitcoin revenue, it's always fluctuating. Bitcoin price, mining difficulty, those halving events.
Precisely. That's the core idea. AI infrastructure offers a pathway to fundamentally de-risk the business model.
How so?
Well, they move from relying on the price of a, volatile commodity, Bitcoin,
Right.
to securing stable, long-term, contract-based utility revenue, often locked in for, say, 3 to 5 years with major clients.
That changes everything for forecasting.
It totally improves their business predictability, stabilizes cash flow, and crucially, it justifies much higher valuation multiples in the public markets.
Right. Investors like stability.
They love it. So Iren is actively aiming to shed that identity of volatility-exposed miner and reposition itself as an AI infrastructure enterprise, a key industrial player in this, new AI economy.
And clearly the market has certainly bought that narrative. I mean, with extraordinary enthusiasm looking at the stock chart. Let's shift our focus now to the results and those bullish drivers that have sent this stock absolutely soaring, that 500% appreciation by October 2025.
Right.
It's phenomenal. But it's the analyst confidence, maybe, that's truly unprecedented.
It really signals this fundamental belief that the company is just not the same entity it was even a year ago. I mean, look at what happened back on October 14th, 2025.
What was that?
Cantor Fitzgerald, a major Wall Street firm, raised its price target from $49 all the way up to $100.
Doubled it. More than doubled it.
And simultaneously, BTI raised its target from $32 to $75.
Okay, so 2 big upgrades on the same day.
Exactly. When you see 2 institutional reports issue such dramatic, synchronized upgrades like that, it reflects this deep collective conviction that IREN is on a growth trajectory comparable to some of the really high-profile AI pure plays out there.
Those price targets are certainly ambitious, but they seem to be built on a bedrock of pretty strong financial improvement from the previous fiscal year. Let's zoom in on FY 2025. The company itself called it a breakthrough year.
And it really was. The transformation was stark. Revenue soared to $501 million,
Yeah.
which is a 168% increase year over year. But I think the most important metric, especially for institutional investors, was the shift in profitability.
From loss to profit.
Big time. They moved from a $28.9 million loss in the prior year to actually achieving net income of $86.9 million.
That's a huge swing.
Huge. And their adjusted EBITDA, which is, a crucial measure of operational performance, that surged nearly 400% year over year to $269.7 million. These results didn't just, support the bull case. They really built the foundation for it.
And the market didn't just reward the stock price, right? It also rewarded their ability to raise capital, to fuel these massive future plans. That successful convertible senior notes offering seems like a major proof point.
Absolutely. That was critical. When Iren went out to raise capital, the demand was frankly overwhelming.
Really?
Yeah, they initially targeted about $875 million for the offering. But due to oversubscription, basically, investors demanding more notes than were available.
A good problem to have.
A very good problem. They expanded the offering to a full $1.0 billion.
$1 billion.
$1 billion. And this really confirms that institutional capital views Iren as a legitimate AI growth story. They were willing to provide financing non-dilutive in the short term, mind you, viewing this as a bet on high-growth AI infrastructure, not just some speculative crypto venture.
Okay, so they've got the money, they've got the momentum. Now, let's talk scale. Because they aren't building server closets here, are they? They're building utility-grade infrastructure, especially down in Texas. Their ambitions, they sound almost unreal when you hear about the Sweetwater project.
They are absolutely thinking hyperscale. They're executing on 2 key infrastructure horizons, as they call them.
Okay.
First, the near term. That's Horizon 1. It's a 50-megawatt capacity, liquid-cooled AI data center located in Childress, Texas.
Liquid-cooled, okay. That's important for these new GPUs.
Essential. This facility is specifically designed for that next-generation high-density hardware like those NVIDIA H-series GPUs we mentioned. And it's targeting operation in Q4 2025, so any day now.
And is there demand?
Crucially, yes. Customer demand is already confirmed to exceed this initial 50 milliW capacity, which demonstrates pretty immediate commercial viability for their AI services.
Okay, 50 megawatts is significant, but Horizon 1, you said, is just the appetizer for Sweetwater.
Exactly.
Yeah.
Sweetwater. That project name almost sounds like a small city's worth of power. And honestly, it kind of is.
Really?
Sweetwater is their flagship project. It's a staggering 2-gigawatt AI and HPC data center development project, also in Texas.
2 gigawatts. That's enormous.
It's hard to even contextualize. To put 2GW in perspective, that's potentially enough power to run hundreds of thousands of homes.
Oh, cow.
And they're phasing this massive build-out. Sweetwater 1, which is 1,400 megawatts, is slated for April 2026. And then Sweetwater 2, the remaining 600 megawatts, is planned for late 2027.
And who needs that kind of scale?
This scale is designed specifically to attract the absolute largest customers. Think the hyperscalers, the major cloud providers, companies who need single deployments ranging from 200 megawatts all the way up to maybe 750 megawatts in one go.
Okay.
This optionality, this sheer scale, that is the primary fuel for those $100 price targets we talked about.
But wait, how can they possibly execute this kind of expansion faster and cheaper than, established rivals? Companies that have been building data centers for decades. That requires a serious competitive edge, doesn't it?
It absolutely does. And their key advantage, they argue, is that vertical integration we mentioned earlier, honed during their years as a Bitcoin miner.
How does that help now?
Well, they don't rely on expensive external contractors for everything. They control the entire process from their proprietary data center design, which is tailored specifically for these high-density liquid-cooled racks, all the way to internal management of the actual construction. They avoid the typical high-cost, maybe over-engineered structures that traditional data centers often use, like reinforced concrete bunkers.
Oh, right, those must be pricey.
Very. They opt instead for their own specialized modular designs. And the bottom line is this results in significantly lower capital expenditure, or CapEx, per megawatt compared to their peers.
And that's crucial for a 2GW rollout.
Absolutely vital. When you're trying to roll out 2 gigawatts of capacity, keeping that CapEx per megawatt down is make or break.
Okay, that is the extremely compelling, very ambitious, and financially aggressive bull case that has pushed this stock up fivefold. But as we mentioned right at the start, the market is deeply divided, which brings us squarely to the skeptical view, the serious headwinds, and particularly those very specific critiques levied by short sellers like Jim Chanos just last month, October 2025.
Right. And Chanos, he focused his critique not really on the ambition, but on the math underpinning that huge valuation.
Okay.
He stated publicly that the bullish analyst reports, the ones projecting $100, rely on, again, ridiculous assumptions, particularly regarding the future profitability of the AI segment.
And specifically, he challenged the profit margins they're projecting, right?
Yeah.
Iren's supporters see phenomenal margins, but Chanos basically says they're way overstating what's achievable in the real world.
Exactly that. The bullish models, apparently, projected that Iren's AI data center business could achieve, get this, 80% marginal EBITDA margins.
80%.
80. Chanos, drawing on years of analyzing industries, argued that the current best-in-class industry achievers, they're not doing much over 50%.
Okay, that's a massive gap. 50% versus 80%. Why would Iren even claim 80% if the industry standard is closer to 50? What's their rationale?
Well, Iren likely bases that 80% projection on their core competitive advantages we just talked about, that proprietary low-cost CapEx design.
Right.
And probably most importantly, their access to extremely cheap, ideally sustainable power. The argument would be if they can lock in power rates significantly below market competitors and keep their construction costs super low, then that marginal revenue drops almost straight to the bottom line, potentially justifying a figure closer to 80%.
Okay, I see the argument. But Chanos' counter-argument, if margins actually end up settling around 50%, the industry norm, that means 30 cents on every single revenue dollar just disappears from the projection. That's a catastrophic financial difference when you scale it up to a 2-gigawatt operation.
It is. Chanos basically suggests that the 80% figure is pure hopium. He argues that operational realities, things like maintenance, cooling costs, unexpected utility price hikes, even just the necessary costs of financing that massive build-out will naturally compress margins much closer to that 50% industry standard.
And if he's right,
if his assessment is correct, the entire valuation thesis, especially those $7,500 targets, is, well, instantly invalidated, or at least severely challenged.
And the margin challenge wasn't even the most pointed accounting critique he made, was it? He also attacked their planned depreciation schedule for their most valuable assets, those NVIDIA GPUs.
Yeah, this is potentially devastating as a critique of financial planning, especially in a high-tech sector like AI. So IREN is planning to invest, what, $2.9 billion into new equipment, mostly those H100s and H200s.
Right.
Chanos pointed out that the models projecting future earnings, the ones supporting the high price targets, are calculating an almost 9-year life for this equipment.
9 years. For a high-end GPU, I mean, in the AI world, that hardware, it feels like it's obsolete before the concrete dries on the data center floor. Aren't we seeing new architectures like NVIDIA's Blackwell launching every, 18 to 24 months?
The pace of AI hardware evolution is just brutal, absolutely brutal. A 9-year depreciation schedule assumes those H100s will generate peak revenue and be fully competitive for almost a decade.
Which seems unlikely.
Highly unlikely. In reality, within maybe 3 years, the H100 will likely be downgraded from premium pricing to, second-tier pricing. Or it might even require replacement entirely with newer tech.
So what's the financial impact if the useful life is much shorter?
Well, if the expected useful life is really only, say, 4 or 5 years instead of 9, the company must accelerate depreciation under accounting rules. This means taking massive immediate write-downs, which significantly increases their reported expenses.
And therefore significantly slashing future earnings estimates, as Chanos put it.
Exactly. You're also creating this huge risk of stranded assets, basically. Expensive, quickly obsolete hardware that still needs maintenance and power, but isn't earning top dollar anymore.
Okay, so on top of the margin skepticism, we have this potentially huge hidden expense lurking in their depreciation schedule. But it wasn't just the short sellers raising flags. We also had major institutions warning about the sheer execution risk involved here. Specifically, that JP Morgan downgraded back in September 2025.
Right, that was significant. JP Morgan downgraded Iren from neutral all the way down to underweight. And that move sent the stock down, 10% initially?
Yeah, it definitely spooked the market.
And they weren't really questioning the long-term potential per se. They were questioning the feasibility right now and the valuation it commanded. Their rationale centered squarely on high execution risk.
Meaning
They argued that the stock, even back in September when it had appreciated only 370% year-to-date.
only 370%.
Right. Even then, they argued, it had already priced in massive, unproven, almost conceptual contracts, particularly that incredibly ambitious 1 gigawatt colocation deal envisioned for Sweetwater.
Yeah, that 1GW Sweetwater deal. It's like the golden goose, isn't it? But it must carry a staggering price tag to build.
It absolutely does. JP Morgan estimated that realizing just that 1 gigawatt of capacity, not even the full 2 GW, would necessitate potentially $10 billion in total capital expenditure.
$10 billion.
$10 billion. And this raises the critical question you touched on earlier. How does a company that reported negative Q1 operating cash flow burning through about $48.2 million?
During cash, yeah.
How do they finance a $10 billion build-out without either catastrophic equity dilution for existing shareholders or taking on immense, potentially crippling debt burdens?
That negative operating cash flow, consuming almost $50 million in just 3 months, it really shows they are actively burning cash right now to fund this growth. The market seems to be pricing in perfect execution, but the financial metrics show a company highly dependent on external financing flowing smoothly.
Exactly. And when you look at their traditional valuation metrics, they just scream high risk. The price-to-sales ratio, the PS, it sits at a towering 378.36.
378 times sales.
Yes. And the price-to-book ratio, PB, is 14.68. These aren't just high, they are astronomical. To put that PS ratio in context, 378.36 implies the market expects the company to execute flawlessly and maintain phenomenal growth for several years just to justify today's price.
That's a lot baked in.
A huge amount. And then consider the, frankly, daunting pre-tax profit margin of negative 567.3%.
Minus 567%.
Yes, which basically means for every dollar of revenue they brought in recently, they were spending over $5. You realize this is just a high-wire act.
For sure.
Now, the capital raised from those convertible notes definitely helps bridge the gap. But the margin for error on executing that Sweetwater build-out on time and on budget is razor thin. Any significant construction delay, any power supply restriction, any hesitation from those big potential customers to sign contracts, it will severely penalize the stock price.
It really does feel like the ultimate high-risk, high-reward scenario. You've got major institutions funding the growth plan via that convertible debt, clearly viewing them as a legitimate AI player, while another major institution like JP Morgan simultaneously downgrades them, warning that the stock already prices in the successful execution of those very same ambitious growth plans.
That tension just perfectly defines the current market sentiment around Iren. And the general risks are tangible, right? They still have some exposure to Bitcoin price volatility until the AI segment completely dominates the revenue picture.
Sure.
There's always the risk of infrastructure construction delays. They already had some minor delays hitting their 50 exahash mining target earlier this year.
Yeah.
And those convertible notes, while they're less dilutive than a straight stock offering right now, still represent potential equity dilution down the road if the stock doesn't perform well above the conversion price.
Okay, let's try to synthesize these opposing views now. Despite the really intense financial scrutiny and these clear bear warnings, the overall analyst consensus rating, it actually remains weighted toward the positive side, doesn't it?
That's right. Surprisingly, perhaps. The average consensus rating across Wall Street is still heavily weighted towards buy. If you look at the, I think, 12 analysts covering the stock, we have 9 buys, 2 holds, and only 2 sells.
So mostly bullish.
Mostly. And the average 12-month target price sits around $63.50. But, and this is key, look at the range of those targets. It spans widely, from JP Morgan's more conservative low target of $24
Okay.
all the way up to Cantor Fitzgerald's extremely bullish $100 high. That massive range perfectly illustrates the market's deep division over the probability of execution success.
It's like analysts are either saying this is going to work spectacularly or this is way too risky at this price.
Pretty much. There's not a lot of middle ground right now.
But the bulls, the ones aiming for $75 or $100, they argue that if you actually believe the growth is coming, then the stock might be, dare I say, undervalued relative to its peer group, even with that crazy PS ratio. How do they rationalize that?
Yeah, it sounds counterintuitive, but they use a relative valuation argument that's based purely on growth expectations.
Okay.
Iren is projected to achieve, by far, the highest sales growth among its direct peer group. We're talking a projected compound annual growth rate, GAGR, of nearly 74.9% between 2025 and 2027.
75% growth per year for 3 years? That's massive.
It's explosive growth.
Yeah.
So when analysts adjust the valuation metrics to account for this explosive growth, they use a specific metric, usually something like the 12-month forward enterprise value divided by sales, and then divide that by the sales growth rate.
Okay, a growth-adjusted multiple.
Exactly. Using that kind of adjusted metric, Iren scores about 2.5 times. And that figure is actually the lowest in its peer group.
Ah, okay. So the argument is, yes, the sticker price, the PS ratio looks expensive right now. But if they actually hit that 75% annual growth target, you're essentially buying into that future massive growth cheaper here on a relative basis than you could with any competing AI infrastructure firm.
That's the pitch. It's a pure bet on volume and velocity of growth.
It really is the ultimate growth investor's thesis, isn't it? You kind of ignore the current PS ratio because you expect the denominator, sales, to multiply exponentially over the next few years.
Exactly. The billion-dollar question, or maybe the $10 billion question here, is whether they can realistically transition from around $500 million in revenue today to several billion within that tight timeline.
And we actually don't have long to wait for the next major data point to test that thesis, do we? We're speaking, as you said, on November 3rd, 2025, and Iren is scheduled to report its Q1 fiscal year 2026 results in just 3 days, November 6th.
Yeah, earnings are imminent. And Wall Street expectations for this report are exceptionally high, which signals, continued optimism about the immediate transition towards that AI business generating real revenue.
How high are we talking?
The consensus expects massive year-over-year increases. Earnings per share, EPS, is projected to jump to $0.17. That's a 177.3% increase from last year.
Wow.
And revenue is expected to hit $236.71 million, which would be a colossal 335.2% increase year over year.
Over 300% revenue growth.
That's the expectation. And interestingly, the Zacks earnings ESP, which tries to predict beats or misses, is currently positive at plus 8.00%. Historically, that suggests analysts are pretty bullish on the probability of an actual earnings beat relative to those high expectations.
The flip side.
The flip side is missing those incredibly elevated expectations, even by a little bit, could be disastrous for the stock. Given the premium valuation it already carries, the pressure is immense.
Absolutely. Okay, let's talk about how management is committing to this pivot internally. What has the CEO, Daniel Roberts, confirmed about their strategic shift moving forward? Is it all in on AI?
Roberts has been pretty unequivocal about it. The core strategy, as communicated, dictated achieving 50 exahashes per second, EHS, for the Bitcoin mining operation by June 2025, and then basically putting the brakes on mining expansion.
Stopping mining growth.
Halting all further expansion in the mining segment. The plan is crystal clear. Focus solely on the potentially higher margin, liquid-cooled AI data centers. That means Horizon 1 and those monumental Sweetwater projects.
So Bitcoin mining effectively becomes the legacy business, the stable cash cow and maybe collateral for loans.
Exactly. It provides baseline cash flow, but AI infrastructure is positioned as the only growth engine going forward.
Okay, so what are the immediate commercial priorities then? What do they need to show the market, like right now, to prove this strategy is working and justify the current share price?
The immediate, absolutely critical priority is successfully securing those commercial partnerships for and getting operational the 50-megawatt Horizon 1 facility this quarter, Q4 2025.
They need signed deals.
Signed deals are paramount. They're reportedly deep in discussions right now with major potential clients.
Yeah.
And that includes everyone from the traditional hyperscalers, the big cloud names, to these newer, aggressive neo-cloud enterprises that are also hungry for capacity. And all of them are seeking that specific high-density, liquid-cooled infrastructure that's necessary for deploying the most advanced AI chips.
So they need to convert interest into contracts.
They need to turn that verbal interest where customers are apparently discussing expanding initial contracts from maybe 50 MW up to 200 MW or even 750 MW later on. They need to turn that talk into ironclad, long-term, contracted revenue streams, pronto.
And then the final priority, the one that really makes or breaks the entire long-term stock thesis. It has to be the execution of Sweetwater.
Absolutely, 100%. Success of this entire AI pivot hinges entirely on a rapid capital-efficient advancement and, crucially, the commercialization of that 2-gigawatt Sweetwater project.
Can they pull it off?
Well, management claims their vertical integration gives them the control they need over power supply, networking, construction timelines. But they simply have to deliver. They need to transition the optionality of having 2 GW of potential capacity into actual contracted capacity with stable long-term revenue streams. Only that can ultimately justify those high-end $75 and $100 valuations. It is, honestly, the purest execution play we have covered in a long, long time.
So we've thoroughly covered both sides here. The phenomenal growth story, the incredibly ambitious AI infrastructure strategy, those ultra-high price targets fueled by all the AI momentum. And we've juxtaposed that with the really critical financial risks, the challenging profit margin assumptions that need to prove true, and the massive execution hurdles highlighted by respected short sellers and conservative institutions like JP Morgan. It's quite the picture.
It really is. And the potential reward, let's be clear, is transformative. Moving from what is essentially a volatile, commodity-exposed mining operation to potentially becoming a stable, almost utility-style AI infrastructure giant. That's the ultimate prize. But the sheer scale and the capital intensity required for that Sweetwater vision, potentially over $10 billion in capital needed, remember?
Yeah, staggering.
It means the execution risk is just exceptionally high. When you invest in Iren today, you are fundamentally betting entirely on management's ability to finance, build, and contract 2 gigawatts of cutting-edge AI data centers faster, cheaper, and ultimately more profitably than pretty much any established industry player.
It's a huge bet on execution.
It's a magnificent engineering and financial challenge, all wrapped up in a fascinating market controversy. It'll be incredible to watch unfold.
Absolutely. Well, that brings us to the end of this deep dive. As always, we want to hear from you. Who you know who know. If there is a company you would like to know more about, please leave a comment.
Yeah, let us know what other companies are on your radar.
Thank you so much for joining us for this deep dive into Iren Limited.